Hi class, and welcome to my demo video for exercise 18-4, 18-5, and 18-9 for chapter 18. Now, like I said before in the introduction video, I was going to give you a little information on the information covered for the chapter before I get into the problems. So that's what I'm doing here. So basically today, for chapter 18, we're going to cover the types of organizations, we're going to talk about, hold on here. We're also going to talk about not-for-profit. We're going to talk about classes of stock. And then we'll close the lecture with par value, or the purpose of it. Okay, so those are the things I'm going to be talking about. I'm just going to highlight that. And I don't know about you guys, but I don't like this break between the lines here. So I'm going to fix that there. Okay, so that's what we're going to be covering today. Basically, when I talk about it, I'll write the notes down so that you can refer back to it if you need to. But in accounting 1 and 2 and 3, we've all touched base on this. But the type of organizations that you are familiar with is 1, sole proprietorships. Okay, and sole proprietorships are owned by one person. And as we know from previous, let me just do this here. And I'm going to bullet these points. There we go. Now, owned by one person, the liability is unlimited, okay, which means that with it in a lawsuit, okay, assets or personal assets can be taken away or confiscated to pay for a debt that's owed during that lawsuit if the person were to lose that lawsuit. Okay. Usually proprietorships are owned by, let me say this, are usually mom and pop shops. And for tax purposes, the income of a proprietorship flows to the personal income tax. Okay, so that's what we know mostly for proprietorships. The second is a partnership. Okay, partnerships are owned by 2 or more people. And partnerships can be LLCs, and LLCs are limited liability companies. So they can incorporate it to say, hey, my liability is limited to what the business has. They can't come after personal assets in case of any form of a loss in the lawsuit. Partnerships can be, there are a lot of partnerships, businesses here in the U.S. It could be, there's a lot of law firms that are partnerships, okay, that's owned by more than one person. Law firms, accounting firms. So examples of okay. And then in this chapter, that's what I'm going to leave for partnerships. In this chapter, we're going to focus more on corporations. Okay. For corporations, we also have the limited liability. Corporations issue stock. Okay. And there are different types of corporations. I'll get into that in a little bit, but I want to list some of the disadvantages of a corporation. Okay, there's a lot of paperwork to incorporate. Okay. There's the double taxation in a corporation. And before I get into more of the disadvantages, I just wanted to mention the ease of raising capital. Okay, it's better suited to raise, corporations are better suited to raise capital other than partnerships or sole proprietorships. And of course, if you of course attract equity capital, it's easier for corporations to raise that capital. And because corporations sell ownership interests in forms of shares of stocks, ownership rights are easily transferred. So, oops, let's go back up here. Okay, there we go. Boy. Okay. Okay, and then within the double taxation area, it's called a double taxation because corporations first pay income tax on their earnings, and when the earnings are distributed to the shareholders or owners of the business, the dividends are also taxed. So that's one form of disadvantage within a corporation. Okay. The double taxation was what I really wanted to mention. Okay. Within types of organizations, we also have types of corporations. So this one would be for profit, okay? If you do go on to your, or if you do go on to obtain your bachelor's degree in accounting, you will have to take a not-for-profit class. Where they will talk about not-for-profit organizations, and these will be your churches, like the Boys and Girls Club, Boys and Girls Club in town here. There's the Salvation Army. All of those are not-for-profit organizations. And hospitals are also not-for-profits. NTCs are not-for-profit. They do not sell stock. Okay. Not organized for profit. Okay. I'm going to try to see if I can, I'm not sure how well you're seeing this. Let's see here, view. There we go. I'm sorry about that. I should have done this a little bit ago. There we go. Okay. See, but I will post this too so you can get the notes if you need to, but okay. And not-for-profit businesses are owned by the FDIC. Okay, and these are government establishments. Okay, that's kind of what I wanted to touch base on, types of organizations. Okay, and then not-for-profit organizations. Let's get into classes of stock. Okay. All right, so there's common stock. Okay. And common stocks basically, if a corporation only has one class of stocks to issue, it's referred to as common stock. Okay. And common stock has 3 different rights. The right to vote, basically for elections of board corporate directors, and 1 share equals 1 vote. Okay. And if someone had, let's say, 51% of the common shares within the business, that means they've got controlling interest. Okay. They also, common stocks also has the right to share in profits. Okay. which means that when dividends are declared, common shareholders get a certain percentage. And common shareholders also have the right to share the distribution of assets if the business were to liquidate. Okay. And to determine what the common shareholder will receive is based on his or her shares within the corporation. Okay. Now we've got preferred stock. Okay. And within preferred stock, there can be Class A, B, C, and so on. It really depends on the business and how they want to classify them. It doesn't have to be A, B, and C. They can do whatever it is that they want to do. You can also distinguish it by, and this is on page 1. Okay, with the classes, okay, which we have. Okay, and then there's also preferred, common stock, and Class B stock. And in the text, this is common for Hershey Foods. Also then, some of the other distinguishing designations also can be called just common or preferred. Okay. Or they can just say capital stock. Oops. Or common and serial preferred. So those are some examples of how stocks can be classified. Okay. Okay. And I'm going to talk about rights of preferred stockholders. Right, so preferred stockholders usually have the right to a preference based on the amount of dividends paid or declared. Okay. So preferred shareholders are paid their dividends before common shareholders receive theirs. Okay. And also, for shareholders, have a preference over common shareholders as to distribution of assets if the company were to liquidate. Okay. And also, preferred stock can be classified as either cumulative or non-cumulative. Okay. For cumulative, dividends, if dividends were not satisfied within any given year, the dividends will carry forward to the subsequent year and should be paid out when dividends are declared. Okay, let me just highlight that. And for non-cumulative, if dividends were not satisfied within any given year, the dividends are, in a sense, let's say the dividends are forfeited. Okay, so with the new year, if dividends are declared and paid, non-cumulative preferred shareholders will get their share for that year only and none from previous years. And in accounting 2, you did work with cumulative and non-cumulative preferred stock. I know that when I taught accounting 2, I made sure that my students got a little bit of this concept down. So I made sure that was, but basically everybody teaches a little different. So in the preferred stock might not have been a requirement. So maybe if you haven't learned it, hopefully you know that by now. Okay. All right, and then the last thing is going to be par value. All right, and in the past, assigning a par value was just, the purpose of it was just to make sure that the shares of stocks weren't going to be, or actually so that they would not fall below par value. And in the past, if a share sold below par value, it was known as watered shares. And this basically created legality issues. So to go ahead and make sure that we can avoid that, many companies now then begin to turn to par value shares, stating with very low par values. and often in pennies. And you'll see that, and you've seen that in the past before. So the purpose of par value is to make sure that the shares do not sell below par value, which is why par value is set to just pennies. Okay, and this is to avoid watered shares and legality issues. Okay, so you'll see that in some of our examples where common stock is usually like 1 cent per share, you know, $1 per share, things like that, and just to avoid some legality issues and avoid the what we call watered shares. So these are the notes then for this chapter. I'm going to pause it, and if you want to pause this at this time before you go into, you continue watching the exercises that I'll be demonstrating in this class, that's perfectly fine with me. So what I'll do is I'll save this, and I'll also attach it to the video along with the Excel demo problems. It'll be exercise 18-4, 5, and 9. So you may pause at this time and take a break if you want. Other than that, you may go on and watch the demonstration videos. It shouldn't be too long. I do have 3 problems, and 2 of the 3 problems are fairly short. Actually, this was 30 minutes, so what I'm going to do is I'm going to go ahead and make this its own video, and then I'll start the video for the demo problems.